from Nick Hill from Moody's Ratings.
Thank you, Mr. Chairman, and thank you for the invitation equally. Moody's, as a credit rating agency, pays a lot of attention naturally to statistics. When I heard a statistic offered earlier that 90% of Cypriots wanted the British to leave, I hesitated. But I did note that carefully, but I want to reassure you that I travelled here on a French passport from Paris, so I think it's okay, and indeed you're still here, sir. So the questions that we were asked to think about on the agenda were around the rate of ECB rate cuts and the ability of the banking sector to provide support to growth and social cohesion. It's a little tricky commenting on ECB rate cuts next to these gentlemen, but Moody's expectation is that the ECB will cut rates pretty rapidly because inflation is likely to fall close to target and remain that way. So we see fairly rapid rate cuts and the refinancing rate settling around about 2.25% in the middle of next year. So on the rate cut side, we think that's where the ECB is heading. On the other question around the banking sector, the European banking sector, and its role in supporting growth, the short answer is yes. We think that the European banking sector is well positioned to support growth because, as we've already heard, capital is good and liquidity is strong. I'll just expand a bit on those things. So first of all, looking back, and I'm going to echo some of the previous remarks, albeit with a credit ratings wrapper. There's been a tremendous convergence in Europe in the last 10 years from our end. And that's happened to economies, to sovereign ratings, and to bank ratings. And we see it all around us here in Cyprus is probably one of the best examples. A decade ago, just over a decade ago, Cyprus's credit rating, the sovereign, was pretty much at the bottom of the rating scale. Today it's a Baa2, so firmly an investment grade with a positive outlook. That's a dramatic change. On the banking side, we see similar convergence, very powerful convergence, and convergence in a good sense, so the weaker parts of the European banking sector becoming much stronger. The difference between the standalone creditworthiness of the top 10th percentile and the bottom 10th percentile has narrowed from 7 notches a bit less than a decade ago to only 3 notches today. So there's been this powerful convergence. And that's been driven by, as we've already heard, a radical improvement in asset quality. Again, in this country, a decade ago, a 50% non-performing loan ratio. We expect it to be less than 3%, I think, at the end of this year. So a radical improvement. Capital, radically stronger. Liquidity and funding, much better. So these have been the drivers of sustained convergence and improvement in the balance sheet of European banks. I should also thank the President of Cyprus for drawing attention to credit ratings in his introductory address this morning. So that's where we are today. In terms of looking ahead, we actually have a fairly constructive outlook for the European bank sector, supported by a number of things. Firstly, economic growth, it's not great, but it's not terrible. And banks are much more sensitive to heavily negative growth than they are to modestly positive growth. So whilst growth remains positive, which is what we expect, and even a bit better next year than this year, that's reasonably supportive of bank credit quality. Secondly, because of the expectation that we have for interest rates, This also provides some relief in terms of potential downside to asset risk, thinking in particular about commercial real estate, for example, which has been a bit of a pain point. That will fade because of lower rates. The counterparty to that is that profitability we expect to decline a little bit as well. But overall, we expect creditworthiness of European banks to fare pretty well. Capital, I should mention, there's always a lot of speculation about capital, particularly given the introduction of Basel III and the new administration in the US and its likely attitude to that. We expect new capital regulations to keep on nudging up the amount of capital in the banking system relative to risk units. So overall, we think the outlook is set fair. Just to conclude, a few caveats, always caveats, and we've heard some of them already. There are some big structural challenges: demographics, decarbonisation, digitalisation, geopolitics. These big structural challenges create the potential for shocks, and that is a concern. We've also, Mr. Governor, you mentioned banking union and the incomplete nature of banking union. So what I said earlier about the convergence of creditworthiness within the European banking sector does not necessarily equate to cohesion because we lack still some of these fundamental pillars of banking union. But overall, the balance sheet of the European banking sector is in pretty good shape, and that puts it in a solid position to resist some of the potential shocks that will inevitably arise at some point. Thank you.
Thank you very much.